Many business owners and high income couples that I work with see the value in having the tax-free income in retirement that comes from a Roth IRA, but for the most part, all of them are over the income threshold that the government actually allows to make these direct contributions into a Roth IRA. But we're going to talk about the Backdoor Roth IRA today, what it is. I'll just break it down in some clear, clean visuals that'll help you understand what it is and why people do it. And then if you have done one of these before, I'm also going to share a red flag I've seen occur several times in the past that you'll want to avoid as well, especially if you've got traditional IRAs or other tax-deferred IRAs. You'll want to stay tuned for that. My promise to you today is we're not going to get into a bunch of numbers. We're going to keep this really simple because I think a lot of times business owners, those people who are busy, kind of overcomplicate this and they make it more difficult than they need to be and sometimes delay even doing it. So with that said, let's get right into explaining. Let's just talk about why someone would do a backdoor Roth IRA. Okay, let's assume they're over the income threshold that the government currently has in place. But why would someone actually do it? Why would they go through all the trouble of having this two-step process and having to file with the IRS come next tax season? And it's all based around RMDs and taxable income in retirement. But before we get there, let's talk about how it looks. So as you can see on screen here, you make a contribution to a traditional IRA the same way you always would. Only this time when you put the money in, you do not take a deduction on it, right? So this is just going to be a non-deductible contribution into your traditional IRA. And directly from there, you're going to move this money over to your Roth IRA. And it's really as simple as that. It's just putting money in to one box and moving it over to another. Like I said, when it comes to the next tax season, so if you're filing in April, if you're filing in October, you're going to file a Form 8606 with the IRS just so they can keep track of the conversion amount and make sure that they're aware of what you're doing. Let's get back to that question of why. Why would someone go through all these hoops? Well, it's all based around RMDs and having a lot of taxable income in retirement. I'm in a unique position where I work with business owners in their 30s, but I also work with retirees in their 60s. So I get to see a little bit of both, and I see the problems that people have in their 60s that they wish they could have changed in their 30s. So as you can see here on the green line that I have as tax-deferred money, you can imagine this as maybe a 401k, maybe an IRA, money that has not been taxed. It is pre-tax, and only when you pull it out is it going to be taxed. So in this instance, we're going to assume that this gets larger and larger over time. And the thing you'll notice alongside it is the taxable income bar, which also gets larger and larger over time. So this jump right here, I meant for that to be Social Security. We'll say this person's taking it at 65, 67, and that is going to increase their taxable income. Okay, because after retirement, a lot of times you'll see your income lower than ever, simply because you're not running the same business, you don't have the same job, and you're only basically pulling money out to cover your living expenses. Now, when you get to age 72 or 75, depending on when you were born, that's when required minimum distributions kick in, or RMDs for short. So if you're born after 1960, you're going to fall at 75, and prior to that, you'll most likely be at 72. So the reason that there's this huge kick up here is this is the age where the government says, okay, now depending on how much longer we expect you to live, we're going to make you take out a certain percentage a year, regardless of if you need it or not. And I made this chart myself. I probably should have made it a little more drastic, because a lot of times I'll see couples need to take out hundreds of thousands of dollars per year from their 401ks and IRAs once they reach this stage. Okay, and even if they only need this amount of money every single year to live, right, the government's making them take out all of this because of those RMDs. And this is on an individual level, so both you and your spouse would have to be doing this. So now let's enter the Roth IRA into the picture here. And the Roth IRA here is just going to be displayed by this gold bar here, okay? Tax-free money compared to tax-deferred money. So yeah, I have a little bit less of tax-deferred money. Maybe my 401k is a little bit smaller. Maybe my IRA is a little bit smaller. But with the Roth IRA, or even with the Roth 401k now that I have, you'll see that this is going to help kind of level out that taxable income in retirement. So like I said, I didn't want to throw a bunch of numbers at you, but you can see how this could potentially lead to, I'm not exaggerating here, millions of dollars sometimes of taxes saved in retirement. And this is a simple visual. Like I said, it's not too technical, but this is kind of the why behind someone would ultimately want to look at doing a backdoor Roth, paying the 32, 35, 37% tax in today's world, even when it's a lot. Let's get into the part where I said I'm going to share a red flag with you, because I've seen people go through all this work and still have to pay 93, 95% tax, not percentage-wise, but 93% of the backdoor Roth conversion amount was taxed simply because they did not understand this rule, and it's based around the pro rata rule, okay? So what you see when you open your portfolio is you see several different accounts, okay? You might have your non-deductible IRA that you're making the contribution into because you want to move it over to your Roth IRA. You might have a traditional IRA, maybe you have a CFP IRA in there from a former employer or an old business. But what the IRS sees is simple. They see tax deferred money and they see after tax money. Have you paid us or have you not? It's as simple as that to them. So for this scenario, what I'm going to assume here is that 93% of your IRA dollars, okay, this is excluding the 401k, we're not including the 401k in this, 93% of that is either in a traditional IRA, a SEP IRA, something that's tax deferred. Because as I mentioned here, the IRS does not view it bucket by bucket, they just view it as one whole here. So in this instance, if you were to move $7,000 or $7,500, depending on how old you are, take any number, you can multiply 93% in this scenario, and that is how much you would have to pay on taxes. Now, a lot of people think that they're paying double tax on the money that they otherwise would have done. You're not paying double tax. Again, the IRS just views you as taking a distribution from this portion, and they just base it into the whole bucket as a whole. So you're not paying double tax. So don't worry about that. You're just paying tax earlier than you otherwise would have or would like to. And you know, a lot of people ask me, Jordan, like, how do I get around this? I want to do a backdoor Roth, but please don't make me, have to do any of this pro rata nonsense. Well, there's one way that's fairly clean. And if your company or your business allows you to convert your IRA dollars, a SEP IRA or traditional IRA, into your 401k, you've essentially gotten this out of the way. So now any backdoor Roth you do with your non-deductible traditional IRA to your Roth IRA, that's all the IRS is going to see, right? You can almost view a delineation between a 401k and the rest of your tax-deferred money, because in that case, if you did move, say, all of those accounts over into a 401k and you just had this little sliver left over of that after-tax money, then of course you can do the Roth conversion, you can do the backdoor Roth, and no questions asked. You just file the form 8606 and you'll be on your way. The last thing I'll mention, guys, and thanks for sticking with me this long, is you need to know the date of December 31st, because the IRS is not going to look at kind of your portfolio as a whole on the day that you did the conversion. They're just going to check on December 31st, okay? If you have tax-deferred IRAs in your name on December 31st and they saw you did one of these, well, then you're going to get flagged for this pro rata rule, okay? So you'll just want to make sure that this is cleaned out before that time. They're going to be checking by then. So guys, I hope this was simple. If you have any questions on this at all, please let me know. I work with business owners. I work with high-income couples that are going through a lot of new complex issues around building their wealth. Would be more than happy to help. But as always, thank you so much, and I'll see you next time.